How we doing? Today is Thursday. Excuse me, today is Tuesday, the 30th of January, 2024. We're just coming to you for our deal review Tuesday. We do this on Tuesdays and Thursdays, where we talk about real estate note investing. We try to break it into small pieces, small parts, and go through the whole process so people are learning and can learn real estate notes. And then we also review deals. Last week, we talked about why we liked notes because of the low risk, high reward. We buy notes at a discount. So if there is a downturn in a market, we usually protect it because of the price point that we pay. Um, Talking about lowering risk, we look at a lot of different factors when it comes to purchasing notes where we can reduce our risk level. And we talked about, just some things like that on why, we like notes and why we want other people to get involved in real estate notes and learn about them. So we'll just take, another step in kind of learning about notes. Again, we don't try to give you too much information, just a little bit so you can grasp it. Hopefully you'll have questions. You want to post those questions. You want to respond to this when you see it, and we can get those answered for you. So basically there are three types of notes that are out there, three categories, I guess, that you would say that they fall into. You have the performing note, you have the non-performing note, and then you have a sub-performing note. So performing just means that the person who's living in the property and who's making the payment is making that payment each and every month. They're usually not late, or if they are a little bit late, they pay the late fee, something like that. But more times than not, they pay on the 1st or the 5th or the 15th, whenever that payment is due. And they've done that for some period of time. Some people will say a note is performing if the person has paid at least three payments. Um, some people will look at it and want a little bit more time that the for the person to show that they pay before they consider it a performing note. But usually, if the person's been making it for about 90 days, they consider that to be a performing note. And somebody may want to sell that. Maybe they, created this note for this particular person for whatever reason. And then after 3 months, they're looking to get the cash maybe that they put into the property. So what they do is they liquidate their note and they sell it. So you can have people that have been in properties for 10 years, 20 years, you know, um, 2 years. It could vary. It can go from all over the place. But that is essentially what a performing note is. A non-performing note is where the person hasn't been paying for at least that same 90 days. Um, they've gotten into trouble, whatever the case may be. You'll see instances where people haven't paid in a number of years. If you're, listening to this from where I am in the Northeast, I'm in New Jersey. People will go 3, 4, 5 years without making payments. So, but if you go past 90 days, typically that's considered a non-performing loan, and most likely the lender is in the process of starting to do a foreclosure, issue that paperwork and things of that nature because this person has not paid. And you have the ability to purchase a non-performing note. And we'll kind of get in why you would, why you want to do that, maybe, the next time that we talk or whatever, or next time that we do this. But you have the ability to purchase those, and then that's one of the categories that these notes fall into. Um, the last category is called a reperforming or semi-performing note. They kind of go hand in hand. A reperforming note is when someone was non-performing. Maybe they went 1 or 2 months, or maybe they did get to the 90 days and, had an issue. But so someone may have gotten into trouble, stopped paying for a certain amount of time, and maybe they, received a certain amount of money, and now they made up for the payments that they missed, um, and they got themselves back on track. So now it is starting to reperform. There was an issue, but the person cured it, and now they're reperforming. Semi-performing goes to where someone has an extended history, meaning over the course of maybe 2, 3, 4, 5 years, where you'll see that they miss two payments. They make a payment after that. Then they maybe double up their next payment to kind of make up for the payment that they missed. Then they'll go 6, 7, 8 months making a payment consistently, then run into some trouble, 8 months, 9 months down the road where they miss a payment. So they're kind of like a spotty. But if you look at it over the course of the time that they've been in the house, they technically may be behind 1 to 2 payments, possibly three, but um, you just know that at some particular point they show a pattern of missing payments for whatever reason. So that's called subperforming. And so each of these different categories, when you're looking at purchasing them, you can purchase them at different discount amounts. For a performing note, you're probably looking at about anywhere from 60 to 70% of the value. Again, we always want to purchase at a discount because we want to protect ourselves in case life happens. Even when someone who is performing and been performing for a number of years or a number of months, always have to prepare yourself for worst case scenario. So if something happens to this person and they can't pay, how did you protect yourself when you purchased this? By purchasing it at that discount, about 70, maybe at the most 75% of the value, just depending on some other factors that we'll talk about later. But you want to kind of be in that range or anything below that. For a non-performing note, you want to be at about a maximum of 55% of the value of the property. You really don't want to go higher than that because the person is not paying already, and the likelihood is that you're most likely going to get that property back either through going through a foreclosure or some type of surrendering the deed. The homeowner, deeds the house back to you because they know that they can't keep up with the payment. But one way or another, you're probably going to get that house back. And usually, the longer someone's been in foreclosure, the more likely it is that you'll get the property back. And so you want to make sure that you're at a discount because, or at that 55% probably max, because you're going to have to possibly pay for a foreclosure. And we kind of factor in those costs depending on what the property is and make sure that, including our foreclosure clause and whatever it is that we have to do to get this property back, we're at about, 50, 55 cents at max of the value. And so, that is why you would want to consider buying those, because if you can buy something at 50, 55 cents on the dollar, you have a pretty good chance of when you get that back that you can sell it for 65 cents on the dollar, 70 cents on the dollar. Or there's a number of other exit strategies that you can do, but at least you know that if you needed to unload it, somebody would pay most likely about 60 cents, 65 cents. So you made all your money back a plus a profit. And that's what we want to do. We want to make sure that we're not losing money. So that's what non-performing is. And then sub-performing, and let's go with reperforming. Again, the person's picked back up, they started paying. You probably want to be a little bit, not as much as you would be on a performing, that 70 to 72 to 75%. You probably want to be somewhere around 65, maybe 60%. I would say, most likely between like 50 and 60%, because if it's subperforming, it could go non-performing at any moment. Maybe the person, is doing all they can to make the payment, but at some point it could just be too much for them. And you have to consider that. So you want to be closer to where you would be on a non-performing when it's subperforming. But if somebody, maybe lived in there a number of years and always made up the payment, always caught back up, so to speak, and this has been going on for about 4 or 5 years, you can feel pretty confident that this person, is going to make all their payments one way or another. They just may be a little late. Maybe you spend a little bit more for that because of the history, but you want to be, in that range and don't want to be too much over that 60 percent threshold on that one. And then the reperformer, well, that was the subperformer. So the reperformer, the person is caught back up. Now you want to look at, well, how long have they consistently made this payment? Now, if it's only been 3 months, I'm probably not going to, be too aggressive when I purchase it. I'm probably going to be, closer to that 50, 55 or less. But if someone has started reperforming and been paying for the last 18 months, maybe I can be around the 60, 65%, something like that, just so, I have some protection. But it seems like, they've gotten back on track with making a payment. So, that's what we wanted to talk about, kind of look at some of the discounts on where you would want to purchase these notes, and then the different categories that they fall into. So with that being said, there is a deal that I saw that looked very interesting and wanted to kind of go over that as an opportunity. Again, notes are really great for people who are looking to get a higher rate of return on investment money that they have. Maybe it's sitting in some type of account. Maybe you have it in an IRA, a 401k, some type of retirement account. There is a way that you can move those funds into another type of retirement vehicle where you have more control, and that's called a self-directed IRA. And if you want more information about that, we can get you over to the right people to talk to you about that. But this example here is this property in Valdosta, Georgia, where, as you can see, the price for this, they're looking to sell this note. Now, this note is performing, one of the categories that we just talked about, and they're selling it. They have an asking price of $34,250. So maybe you've been at your job sometime 6, 7, 8, 10, 15 years. You have a certain amount of money, built up in your retirement account. Because of what they're offering this property at, you can get yourself anywhere from a 9.5 to about 10 and 10.25 return on money. So I don't know if you have money sitting somewhere that is getting you 3%, 4%, 5%, no percent, you may want to consider coming over, looking at the opportunity that's in notes because of the returns that you get. And the biggest reason why this one looks so attractive here is because when we go to the value of the property, so let's do that, and we'll see what that is. Right now, this real estimate on realtor.com is telling me, that this property is worth anywhere between, about $85,000. So your investment to value, what you're investing in ratio to what the value of the property is around 35, 40%. So let's just say, and this one is a performer, so the person is paying. So you're gonna most likely, start to receive payments, when you purchase this thing. Would you not buy something at 40 cents, 35 cents on the dollar, knowing that it's worth, what it's worth? Would you not do that? Would you not feel safe? Would you not feel comfortable knowing that if I purchased this right now, but if I had to go out and sell it to the market, I could sell it at 50 cents, 55 cents on the dollar and make back all my money plus a return? That's what makes this deal, one of the biggest things that are attractive. The second thing is that this loan was created back in 2007. And actually, when I went into public record, It looks like they actually may have had it even before then. I don't know if maybe something happened with the owners at a certain time and they had to redo this particular loan, but it looks like these owners go back to the 1990s with this property. So it could have been a family thing, but I have to dive a little bit deeper into the documentation. But let's just say, for argument's sake, that they've had it since 2007. How much equity have they built up into this particular property up until now? Over the last, what's that, 16 years, going into be 17 years this year? They roughly have, because the unpaid balance, the total payoff right now is 50,000. So they've accumulated $35,000 worth of equity. That doesn't seem like a lot, but if something does go wrong with the owners, what are they going to do? They're most likely going to sell the property. They wouldn't want to just leave $35,000 on the table. They would sell it. So you're protected there. The chances of this going to a foreclosure proceeding is low. The probability of it is low because of the equity that they have. And again, they are paying. They have I think they had the history, of the payments right here. Uh, so, we have that. And it shows that, they pretty much play, they're caught up and they make the payments. I'll look at this a little bit closer and I'll look at it a little bit closer, but it looks like they make the payment. And if, again, how we talked about, they may miss a payment, but they do make it up. So, um, if they ever ran into some real serious issues, they could just sell the property. Or would they not take X amount of dollars to walk away from the property? Instead of getting $35,000, could you not give them maybe an extra $10,000 to get the property from them and let them go on about their business? You could do that if they got into that type of situation, but most likely this is going to continue to keep paying and until it's paid off. And then if you do that and you purchase it at this $34,250, you're looking at roughly a 10% return on this. I think maybe even slightly above that at that particular number. And then two, the what's happening as well is because you have this unpaid balance of about $50,000. So some people must say, well, why are they only selling it for 34,000 when they have 50,000 to pay off? They could need the money for one, but the other thing is because this one was written at such a low interest. 5.2 is really low. When you create notes, you don't want to create notes with that low of an interest rate, because that's probably at the time that they wrote this might have been at or below the market, the market interest rate at that time. I don't think in 2007, we were down to 2 or 3% interest rates. I could be wrong, but even if we were, the reason why you don't want to do that is because when it is time to sell, you're having to take a big discount off of, first of all, the unpaid balance, but then again, because we're already going to try to get a discount off of the market value, but now you're not going to get all of that money that you are owed, or close to the amount that you are owed, because we need for investors to get their interest rate. They don't want to just, a lot of investors don't want a 6% or 7% return. They want something 9, 10, 11%, something like that. They want those higher returns. And so when you try and sell this, and this is what they look for most of the time, this is why you can get this at this particular price. And so just want to kind of take a look at the property as well. There's a lot of assets out there that are in this price range. So for everybody that, they think that they have to have maybe, a certain amount of money, or, a lot of times this can be done with, like I said, retirement money. money that's sitting in an account. Maybe you and a friend could come together, split this down the middle. One put in a certain amount, the other puts a certain amount. You'll each, get roughly a 10% return on your money. And you are now, in the real estate game. So this is the property right here. Nice little small house in this particular area. This is what's customary for the area. A lot of times what we do too is we, look and we go down the street and we see what's going on. Um, this looks like a little decent residential neighborhood. And like I said, the houses are very similar. So we look at that as well, just to kind of see what the area looks like. We'll look into things like crime and stuff like that as well, but because you have to factor in that. But just for today, the biggest thing that I was just trying to get people to see is two things. The amount that some of these deals that are offered at, and what the property looks like, and the interest rate, and the type of interest that you can make on this maybe lesser amount of money. How many times are you putting in that to go out here and buy, a multifamily, to be a landlord, to go and buy a fix and flip? This way, this money is just going, you purchase the note, they transfer it over to you. You start collecting this $365.69 per month until it's paid off. If anything goes wrong, you can always get the property back, sell this on the open market, or you could, do your own note. You can create your own note on this for somebody else. Maybe there's another homeowner in the area that would love to live in this property. You can structure a note around $85,000 worth of value. And then you start collecting payments from that particular person. But the clock starts all over again with that person, whether you do maybe 180 months, which is 15 years, or if you do 360 months, which is 30 years, you can create it how you want to create it. But now you'll probably be getting a higher monthly payment because now you're selling the property for more money and creating the terms. You're going to create them properly. You're not going to create it at 5.2% like this one. So you're going to get more of a monthly payment. And let's just say you didn't want to do that or whatever the case may be. You still have other options. Could you not, depending on what the condition of the property is, maybe you want to put a little bit of work in it and sell it for the 85. So now you've maybe made, after the cost to put some work into it and the closing costs and realtor fees, maybe you made $60,000 on top of collecting payments, because we still don't know when this loan could possibly go bad. So you've collected payments. Maybe you collect the payments 2, 3, 4 years, and then something happened. And then again, you still have a lot of things that you can do with it. If you didn't want to do either one of those, maybe you just want to turn it into a rental. I wouldn't personally suggest that you do a rental model, but maybe you want to do that. Is somebody going to rent this is rent in this area going to be more or less than $365? Well, let's go see. Let's do that. That'll be the last thing that we do, just to see what the rental amount is. Where is that? Oh, here it is. Okay. So let's pop that in. I'm pretty sure the rent is going to be at least double than what it would cost than what it would cost for somebody to own the property. $940 is the average rent in this area. So hey, you may even want to rent it because of that. It's almost three times is what it would cost you to offer it, as a homeowner. Well, one quick thing. Let's run the numbers. Let's see, how close to 940 we can get. Let's just say the value of it is 85,000 if we took this property back. And let's just say we wrote it at 10% for 360 months. So that's $745. Now with your taxes, insurance, things like that, you'll probably be spending an extra $200 or $250, um, for taxes and insurance. That puts you right at about that 940, just under $1,000 maybe. Let's just say it's $1,000. A lot of times people will pay a little bit more than the average rent to own. So you might be able to even write this a little bit higher rate, but you could do that if you took the property back, get $745. So you've pretty much doubled your cash flow. And you don't, as a note holder, you don't have to get involved in doing any repairs or maintenance or anything like that, any responsibility or liability for the actual property. So that's why we want to possibly create another note for someone, if this ever came back to us. So like I said, that's what we wanted to show. Again, we just want to take little bit by little bit, start breaking it down, and then show you actual deals that are out there. We'll be back on Thursday at this time. We'll look at possibly a deal where we can create the note, and we'll show you how that works. If you have the same $35,000, but you can use it in another type of deal where you're just collecting payments. We'll show you, some of that stuff as well on Thursdays, 8:15 p.m. Eastern Standard Time. And again, we're usually not here longer than 30 minutes or so. So if you catch the replay, make a comment, share it with someone. If you're not, in the business right now to invest, but maybe you're around some people that are, please share it with them. And just try to at least learn the information. So when you get yourself prepared and get yourself in a better situation where you want to invest, you'll understand notes and what they are. A great way to break into real estate. So again, back on Thursday, 8:15 p.m. And you can catch us right here, either on Instagram or with the Zoom link. So we'll be posting it. Just look for us. If you have any questions, just post them and we will definitely answer. So we'll see everybody back on Thursday. Have a good night.